Ethan Austin joins us today from Santa Barbara. He's the founding partner at Outside VC, a pre-seed venture firm backing outsider founders building financial inclusion and equitable systems. Ethan is the former MD of Techstars in Denver, helped launch Techstars LA, and co-founded GiveForward, the first medical crowdfunding platform acquired by GoFundMe. Ethan, welcome to the show.
Thanks for having me, Nick.
Yeah, it's good to see you again. So tell us a bit about your backstory and your path to venture.
Yeah, I was a founder for 8 years in Chicago, and we built a company called GiveForward. It was one of the very first crowdfunding platforms. We did that for 8 years. In year 8, Facebook decided they were going to build the same thing and kind of took us out within a year, which was a pretty brutal ending to 8 years of work. Tried to recruit us to join their team and be the first product managers, building out what they were starting, an impact team. Built our product the next year. So we saw something die overnight, basically, which was pretty hard. We ultimately, sold to GoFundMe, but it wasn't one of those acquisitions where the price was named, right? So, one of our angel investors, the guy David Cohen, founded Techstars. He pulled me into Techstars. I launched Techstars LA with Anna Barber, 2017, 2018, and then went to Denver to do another Techstars program we ran with Western Union around FinTech. And I did that for a couple of years, and I wasn't sure if I was going to start another company or not. And after a while, I just realized I loved what I was doing. And I always had that founder itch still a little bit, and so I wanted to start my own thing as opposed to joining a venture firm. And so in 2022, spring 2022, I went out to start raising for Outside VC and really tried to build the firm I wish existed when I was a founder. And that was really what the idea was about. Like we were founders and had to bootstrap for 2.5 years because we were outsiders and no one backed us until the thing became kind of obvious. And that was the idea behind Outside VC, is just kind of jumping in earlier before things are obvious and being first believers into founders.
Good stuff. So, as you reflect on that journey, as a founder, what do you think, worked, what didn't work? Obviously the outcome wasn't what you wanted, but what are kind of your main lessons from that?
Yeah, I mean, like lesson one, just go and jump in and do it, right? Like that was the hardest thing of all. I think lesson two, sometimes I laugh. I was like, what are the thing we did best? We just stuck around long enough to kind of catch the wave. You had to be there at the right exact time to do what we were doing. So we launched in 2008. Next year, Kickstarter launched. The year after that, GoFundMe launched. The same year, we launched, Indiegogo launched. And none of these things would have happened had Facebook not really been going from 200 million to 1 billion users in that same time period. We got 80% of our traffic from Facebook. And so we kind of live by the sword, die by the sword. None of us would have existed had Facebook not existed. So just sticking around and being scrappy for those couple of years, and, had Kickstarter not come out the year after and kind of educated the market, they blew up a little bit, and that helped all of us. And so I think just staying alive was pretty critical. But then also kind of finding a way to differentiate. So we launched in 2008. 5 years later, there was 1,000 crowdfunding platforms. There was the Jobs Act had happened, right? Like there was federal law around crowdfunding. We helped start this thing, and then it blew up behind us. And you look today at crowdfunding and all the platforms today, they're still exactly the same. There's no technological moat. There's no everything was exactly the same. So you're in this completely undifferentiated space. How do you stand out? And one lesson learned really was around positioning, and we positioned ourselves differently. We found a path that made sense, which was medical crowdfunding. We pivoted before we knew what the word pivot was. I don't think it was a word back then. We were just we started off doing fundraising for everything and narrowed into fundraising for medical expenses when we saw that was where people really needed us. And then positioned ourselves differently than everyone else, because from a technology standpoint, we're all the same. And so we positioned our core values. We didn't realize it at the time, but we were creating a brand based on our core values, and it emanated out into how we acted and how we approached the world. And that positioned us differently in the market, where people would come to us because of what we stood for, right? Our mantra is create unexpected joy. And our core, number one core value is cultivate through compassion. And when you're looking at all the different crowdfunding platforms that look the same, people would choose the one that felt like it spoke to them. And I think that was something that stuck with me of like, how did it really differentiate it in a pretty undifferentiated space?
You mentioned timing, like, you started the business at the right time and were around long enough to kind of benefit from the way that the market moved. How much of that is a factor when you're assessing prospective investments? Do you think a lot about timing, and is that like a critical component to your diligence process?
I think a lot about, I'm reluctant to invest into something that has been in existence for a long time, or there's a pretty competitive space, because it's so hard. Then you're just really betting on, is this founder or is this team like great at executing? Will they out execute everyone else? I tend to not look at trends, right? Because I'm a pre-seed investor. If I'm looking at trends, I'm probably already too late. I want to look at the things that that sound a little weird in the beginning. Like when we were starting this in 2008, we didn't even call it crowdfunding. We called it peer-to-peer fundraising. It wasn't a thing yet. And so, we're not investing solely in category creating companies, but I think if you can try to, or at least if we can try to, invest in the things before they become the thing, that's where we can get in early at like a lower valuation, where the multiples are going to be a lot higher down the road. And just believe that the founders are going to find the right path. So, I don't look at it as like try and time everything. I just look at it as like, I'm okay investing in these things that seem really weird right now. And maybe they'll be in the right place at the right time to catch the wave in a couple years.
So tell us about the founding of Outside. Obviously you left Techstars. You felt like it was time to launch your own fund. What is the thesis, and what was the origin story there?
Yeah. The thesis was really just around, outsider founders. So you look at like some of the best founders in the world. You look at, just Larry Ellison. I don't use this one as an example very often, but he recently became, the richest person in the world for a moment. I think Elon Musk took him over again. But like Larry Ellison was, grew up poor in the Bronx, was adopted, was dropped out of college, right? He was not the type of person that you think that most VCs would look at as saying is going to be the future richest person in the world, right? Steve Jobs was an adopted hippie, pretty heavy drug user, got kicked out of his own company. Most VCs wouldn't have said that guy's going to build the biggest company in the world. Elon Musk, an immigrant, different on every level from just about everyone else, not typical insider, not the person most people would have said is going to build the biggest company, one of the biggest companies, or many companies in the world. And so like all of these people, if you go down the list of like the biggest companies, consistently they're built by these people who don't look like what insider VCs are typically investing in. And, it was really drawn from our own experience. I came straight from law school with no experience. And my co-founder, she worked at a nonprofit for, a couple of years and like had no real tech experience in 2008. And no one wanted to bet on us. And I think oftentimes, like as you start digging in, these are the folks who end up building some of the biggest companies. And so it was drawn from my own experiences. I dug in more. I just saw that there was a bit of a pattern here. And so I leaned into it. And we kicked it off in 2022 in spring, right as the market tanked, and it was like an incredibly hard fundraising time to fundraise, and kind of muscled through it and got to a small little fund just by pushing our way through. But what we've seen so far is that it just really resonates with founders. The founders are like, yeah, that speaks to me. Even in all these people that you think are insiders, it turns out they raise their hands and say like, oh no, I'm an outsider. And so that's one thing we've kind of seen is like we plant our flag, it's drawn in talent beyond what we thought we'd be able to do otherwise.
So like three of the names you mentioned, Larry Ellison, Steve Jobs, Elon Musk, these are all very extreme personalities, challenging convention type of folks. Like, how do you tease out when you're meeting founders? You want them to be off consensus, but they can't be so far off that you can never get future funding. You can't get into a Series A. So talk to us a bit about the profile and the characteristics that, you think make for a strong investment.
Yeah. I think I look for like three main things, and two of them are outsider traits, and one of them is not really an outsider trait. But, first one is like they have some, because of their lived experience, because of where they came from, or because of what they've lived through, or their circuitous path to how they've got here, they have some unique insight, right, into the world. And that's probably different than the way other people are seeing the world. And so that's something that I look for first. And then, there's two other things that like they usually do things differently than everyone else. So they usually operate from first principles. They're not usually operating from, we did things 20 years at this company and this is how things are done. They're just operating from their own set of, values, their own North Star, and their own way of doing things. And usually it's weird or peculiar, like why, and I look for that a lot, like this little thing, why are you doing that? Like, that's weird. Tell me about that. And, and it's like little nuanced things. And like, those are the things that I kind of get excited about when people are not doing the things that everyone else is doing, but like they just operate a little bit differently. And it could be just like how they're running their fundraising process. Like, why are you running it this way? Or like, what's this strange little thing you're doing? So that's something. And then like just people who are, I think outsiders tend to be grittier, right? Like, so I'd say like probably half the companies we've backed were immigrants. And like, I think if you immigrate to a country, if you're willing to like, risk everything to come to a country, like starting a startup doesn't seem that risky. And you're willing to push through walls. And, someone wrote like, a lot of people doubted Larry Ellison, and like people with a chip on their shoulder sometimes are just willing to push through walls longer, right? Like I said, for ourselves, like we just stayed alive for 2.5 years. We were one to keep pushing and pushing and pushing. And I think the founders that tend to stay alive and just keep pushing and have something to prove, tend to end up building big companies because they're there when the wave hits. And then from non-outsider stuff, I look for founders that have just been like, I ask people if they've been top 1% in something in their life. And I don't care what it is. It can be something super esoteric, but it just, shows that someone has the willingness to push forward in something and has that drive to really be great.
A lot of founders talk about these characteristics, like founders that are thorny or, bristly or, have sharp edges. And I'm curious, when you're working with some of these founders, do you try and smooth those out? Do you coach them, before they go out for the A? Or do you just tell them that, lean into it and just do your thing, and maybe we'll find somebody that responds?
I mean, I've been on both ends of that, right? I used to say, like, who do you look for? I'd say, like, I look for founders that are psychopath adjacent, which is probably not the most PC thing to say, but right up to the line, because I think they're just a little bit different. And you've, been in scenarios where you've been like, oh no, that was too far over the line, and this person, is just, you misjudge stuff, like companies have, been involved with in the past, and then. I tend to say lean into it, honestly, and like hopefully you'll find the right investors for you. And who am I to say, that you're doing things wrong when, I think these people, like these really, really smart people, or people who are peculiar or see the world differently, are just seeing things that the rest of us aren't. And so there's a little bit of coaching. I tend to give people coaching. I tend to kind of tell people how VCs are thinking or why they're doing certain things, and just kind of unveil a little bit. It's because it's pretty opaque for founders who don't know. But usually I tell them to lean into it and, let the cards fall where they might.
Awesome. So one thing about Techstars, we just had David Cohen on, and recently had Brad Feld on again. Techstars does a lot of deals, right? And so you worked with Denver, you worked with LA, you've had reps, you've had shots on goal. If you were to go back and think about the portfolios that were built as part of those programs, going into the programs, often people will say, oh, I feel like these are the few that have what it takes. Do you find that usually you knew early on, or do you think you were surprised frequently? Like the ones that were not predicted to be the successes ended up finding it somehow.
Yeah. I think a little A, a little B. So, early on, we lost some companies to venture firms who we'd competed against. And, sometimes we'd lose some of you'd stack rank your companies ahead of time. And, if we it's pretty common. You might lose your top one or two companies or, one company out of, to a venture firm. And that always stung because you're like, oh, this was going to be the one. So I learned early on, advice I try to give other MDs when they were joining Techstars is just like, make sure you get your one, make sure you get your top two, your top three, your top four. And it's like, do whatever you can to close them. And I think that was something that stuck with me with outside VC. We've never, been pushed out of a competitive round out of I think 14 rounds now, and just always close. But then on the flip side, I think a lot of the companies, you don't know these are so early, right? And one of our best companies out of, one of my Techstars Denver classes, we stacked ranked them. I never had them ranked higher than 5th out of 10 during the time. And now I'm like, oh yeah, that company's a runaway. And you just don't know at the time. Half the time it's they were earlier than other folks, but now it seems like they're going to be a monster, and you're just never really sure. So I think you have to go in with a bit of humility, knowing things change, and these are really, really early companies.
And give me your sense on follow-on funding. I understand that you're not reserving for the current fund. But as you think about follow-on funding and you've seen kind of the approach at Techstars, there's many out there that say you have to double down on your winners, figure out which ones your winners are, and jam money because you've got the best information, right? It's information asymmetry with the rest of the market. Versus I spoke with an LP 2 weeks ago, and his position was the first check is always the best check, and it's the best decision-making process for underwriting, and the decision-making actually gets worse over time because of bias and because of sunk cost. And it was kind of an interesting perspective. So what are your thoughts on the strategic side of follow-on funding and one's ability to make better decisions as a company gets more maturity and an investor gets more information?
I think it depends on the firm, right? I don't think, I talked to so many people when I started this, people who've done phenomenally well, who have said, we never, do follow-ons, and we always do follow-ons. And I think both paths can work. We did a tiny bit of follow-on in Fund 1, and I've tended, for Fund 2, we're not doing any follow-on with the idea, the valuation's the lowest in the first round. And as a small fund, we just don't have, tons of opportunities to do follow-ons and use that capital to invest, at 6 times the valuation or 3 times the valuation or whatever that might be. I think it's also harder. I've learned, I think you should, it's good to stay in your swim lane, and it's good to understand where you're best. I think each diligence process at each stage is different, right? And you're following on a seed plus or a series A. It's a different calculus than when you're investing pre-seed. And if you get really, really good at one space, it doesn't mean you're good at another. And so maybe if you have a firm where one partner is I've heard of firms where one partner focuses on follow-on only, and they have a partner, to avoid all the bias of this was a company I believe in, that could work. But as a solo GP, I've said, look, I don't want to bring that bias into the decision, and I don't want to make poor decisions when, you should have better knowledge, but you don't always, right? It's you don't always, it's not always obvious to see, 1 stage later or 2 stages later. A lot of these companies, just sometimes, you hear so many stories of we were the only firm that backed this company for multiple rounds. It wasn't obvious, and then it became obvious, by the series B or C. And so I've thought, let's get as much capital in the beginning and as much ownership in as the beginning when the company's needed the most, right? When no one else is really backing them, versus putting more in when, it seems like something's on its way, but you just never know.
So, Ethan, one of the words that comes up frequently when speaking with investors is edge, right? Lots of allocators are looking for edge when they're picking VC funds. Of course, we're looking for founders with some sort of edge. And in the VC space, it's usually framed around sourcing, picking, or support. Where does your edge come from at Outside?
Yeah, I think of sourcing as the top of the funnel and winning as the bottom. I think picking is really hard, right? And you think if you look at people picking, it's like YCs. Like if you look at 100x returners, they're like at 1%, and they're one of the best all-time firms, right? And you look at Fred Wilson, I think he's at the top end of that spectrum. He was at like 6%, and like picking at Series A, which is a narrower funnel at that point already, and he's probably one of the best of all time. And I think picking early stage, David Cohen told me early on, he's like, make sure you have enough portfolio companies in your portfolio construction, because you're going to see halfway into this that like you think you're a better picker than everyone else, and everyone tends to be kind of around the same. And so I think picking is really tricky. I think sourcing for me is where things get I think differentiated. I think if you look at the best firms in the world, you look at a Sequoia, for instance, like everyone, they win because every single company in the world is going to take their money, right? And so I think it's really hard to build a great firm just through sourcing through network. Like everyone sources through network. Every VC has a good network. That doesn't make you different, right? That makes you the same as everyone else. And I think unless people are coming to you saying, oh my God, Nick, I want to work with you, or oh my God, Ethan, I want to work with you because of what you believe in, because this aligns with my worldview, because I think that's the hack. And we had founders reaching out to me the other day who were like, yeah, we built our first company. It was we exited for mid 8 figures, and we built our second company and exited for mid 8 figures. And we're building this third one. We'd like to get you involved. And I was like, why? Just like, oh, we've just been reading the stuff you've been writing about outsiders online. And just like, it struck a chord with us. And so I think it allows you to punch above your weight class. Like, going back to what we did with Give Forward and positioning yourself in the market in an undifferentiated space, I think it allows you to punch above your weight class. When if you say we're just doing FinTech and climate, okay, so what, right? And so I think saying that we stand for something and saying we believe in something draws in people that we normally would never have seen. And so Fund 1, most of our investments came through network, 24 of 28. But I think 5 of our last 12 and 3 of our first 4 in Fund 2 have now come as cold inbound. Where a lot of people don't like cold inbound, I'm like, I love it. I want people finding us and digging through the stuff to be like, oh yeah, this is a great. And I think you end up with pretty differentiated deal flow from everyone else that way. Could be wrong on them, but we're seeing stuff that I think other people aren't seeing.
And what's the approach to support, right? After you're in a deal, like, what's your standard way of working with founders and helping them out?
Yeah. So we'll do everything that, we're the therapist to, financials, bringing in other, like most founders need, and everyone who's going through Techstars, and I find this true of all early stage founders, like most people need help with fundraising. They don't have a lot of at-bats there, right? They could be good at running a company, but like you haven't fundraised that many times, needing help with like closing the round. So like, I think every company in Fund 2 so far, we've helped bring in additional investors into the round. And sometimes like in 2 of the companies, we've been the first institutional investor, and in 2 of them, we've been the second institutional investor. And so it's always early in the round when they need help, really coalescing that round and getting it done. Beyond that, like that first like real hard push, like I think I try to be responsive as opposed to telling people what they need to do. So typically we'll be the first person to respond on any investor update, and just say, whatever you need, we'll be here for that, and a lot of it's sometimes helping them think through stuff, being there as a friend when they need it. And like, I say friendvestor is kind of the swim lane we swim in, and kind of being there as a friend who I think tells people when they're screwing up, right? Not just being nice to them, but like actually telling them like, hey, this thing over here doesn't make sense, and doing it in a way that's kind and people actually listen to because they know of like their best interest.
Ethan, as a as a generalist, how do you build knowledge? How do you build context when you're making investment decisions in spaces that you have, limited to no experience?
We focus on two areas. So we focus on fintech and climate. But I would say like the thing that I've done that's been the most helpful is I designed my LP base, both by necessity and by design, right? I told you it was 2022 or fundraising. So I had 180 LPs in Fund One, which is like a crazy way to fundraise. And so there's all small checks from operators and other VCs. And so we have 30 plus VCs in our LP base. We have 30 to 40 fintech CEOs or operators or execs. And we have, climate experts. And like, so anytime we have, a space that I don't, know deeply enough, I have this great network of people that I can reach out to that are just in our LP base that dig in for us and help think through problems and, spot out, here's the challenges with this, or this is a really great opportunity. And so I use this LP base as like a mini expert network.
Awesome. You recently wrote about advice you received from a notable LP. They said, keep it simple, stories matter, and LPs are looking for weirdos, not normal people, investors who are a little off, as you put it. What do you think makes you the kind of weird VC that LPs are looking for?
Well, TBD if I am the weird VC that LPs are looking for. But, I was surprised that they said that, honestly. I was, and they said a lot of things in this session. And I was surprised that, it was a panel of VCs all in, button-down shirts and looking pretty traditional. So I was kind of shocked when he said this. And, Brad Feld was in the room. He kind of looked at Brad, he's kind of pointed to Brad. He's like, Brad's a little off, and you're looking at people who can kind of see around corners in a little bit and are just not doing things the same way as everyone else, which was surprising because that's why I said earlier, what I look for in founders. I look for people who are kind of building off first principles and doing their own thing and not really caring what the rest of the market's doing. So I think I've tried to do that my whole career as a founder and now as a VC. TBD, of course, if it all works out, but like it's probably not going to end up with, average returns. Is going to end up on one end of the spectrum or the other. But I think, the whole approach of everything we're doing is just always a little bit different than, what everyone else is doing. At least that's what, my LPs have said of like, who are coming back in for Fund Two. Said, Ethan, I don't know if this is going to work or not, but I know you're doing things differently than all the other investors, all the other funds that we're investing into. So we're curious to see how this all turns out.
So Ethan, your thesis, you invest in fintech, you invest in climate. Climate's gone through some ups and downs as of late. What specific areas within climate are you focused on and spending the most time on?
Yeah. For the most part, we're spending stuff on software. We're not spending stuff on like the real sci-fi climate stuff. We're a tiny little fund. So it's, the stuff with crazy CapEx. So we're not really investing into. We've invested in multiple companies and doing electrification, both on the consumer side and on manufacturing side, and thinking through like, what does this look like in the future as we transition to, different energy sources. We've done stuff in data, a company called Volteris, which is almost like it's like Plaid, but for EV data, and connecting manufacturers, auto manufacturers, with anyone who wants to build on top of EV data. So like almost all of it's been software. We're really lucky. One of our LPs is this guy, Kiran Bhattaraju, who's been incredibly involved. He's the founder of a company called Arcadia in the climate space. He's been every single company we've looked at. He's either helped us source, he's helped us diligence, and he's helped us win some over because, I don't have as much experience in climate, and you tell any founder that Kieran's going to be involved, and he'll jump on a call with folks, and people always want him on the cap table and want him involved, and so he's been able to close companies that I think sometimes we wouldn't have been able to get into. But it's mostly software. We did one software hardware company that was composting. That was just a really cool, interesting company that's doing great. And I think a lot of people wouldn't touch it because of the hardware aspects of it. And so they just had a narrow band of investors that would look at it. And that was one we did and have been really happy with. So we're
Awesome.
I wouldn't say we're agnostic, but it's still for us. We're betting so early that it's usually just founder based.
How about trends on the FinTech side? How have you seen that sector evolve over time, and what gets you excited?
Yeah. I mean, I'll say the same thing in FinTech is like, we're always looking for founders. I think we're betting so early on companies that if we're looking at trends, then we're kind of getting in trouble. So one trend we invested in recently, when I was running the Techstars Western Union program, we were seeing stuff in stable coins back in 2019, and we kind of looked at stuff back then. I think that's, one of my biggest misses was a stablecoin infrastructure company that we didn't invest in from our 2020 class. But that's a trend that has really kind of come up in the last couple of years. And there was a decent size acquisition by Stripe that kind of, turned everyone on to saying, hey, this is actually probably going to be a thing, and stablecoins are going to be a thing, and it's kind of moving over. And we invested last year into a stablecoin company, that infrastructure company that's doing great. But for the most part, we're trying to avoid the trends, because we're such a small fund. We're making first bets that we're usually a first company in. So we just invested in a company in the insurance space that's doing layoff insurance for people, betting on all right, well, AI, if this is to happen and people are going to be getting laid off and people's jobs are going to be getting lost, we bet on a company doing that. And so we're hopefully getting in before these things become trends. And, hopefully that's not the case with AI, but, it's kind of a hedge in case it is, that we're betting on companies kind of looking at what are the ramifications if this thing really takes off.
Awesome. Charles Hudson was recently on the show, and he wrote recently about what it means to be a VC. How do you define the role today, and what do you think most investors still get wrong about the job?
Oh, that's a good question. How do I define the role today? I mean, I think it's different at every stage. I don't know how to define it for every stage, but I know for us, it's being a first believer, right? I think of taking risks when other people are unwilling to. And I get all the question all the time from founders, someone asked me yesterday, how much revenue do I need? And can I raise without any revenue? And I'm like, it's hard. It's hard to do that. A lot of people are not willing to take a bet on something that's pre-revenue. And there's a very narrow number of VCs that are still kind of willing to do that. Angels, sure. Individuals, sure. But, an institutional VC, I think that's tough. So I think, my role and the role I like to play is being a first believer. I still talk to the people that were first believers, in my company 15 years ago. They're still my mentors and people that I'm, very close with today and have lifted me up over the course of my career. And so I think that's a critical role that's largely missing. There's a lot of consensus capital, and there's a lot of people making safe bets. But, I think venture capital was, originally in this very cottage industry, and has become bigger and bigger as it started to scale. And with that is less, we have a narrower band of things that we really think fall into the good range. And I think looking outside, with a little bit of a wider aperture, either based on what the company does or who the founder is what venture capital used to be, and what I've tried to kind of bring outside VC as going back to. We were backed by, it's a company a Founder Collective, which I think was always looking at these weird, wonderful things, and they're decidedly antithesis, and we're just looking at this weird stuff. And I think I was very much shaped by that philosophy and trying to look a little bit further out of, not saying I know what the future holds, but saying, let's be open about what it could be.
Awesome. Ethan, liquidity is becoming a bigger topic earlier in a startup's life. We're seeing companies that are giving employees liquidity options before exits. We're seeing private markets reshape and new concepts coming to address some of these issues. How do you see early liquidity shaping founder and employee incentives going forward?
I don't know how it's like. I don't know what most companies are doing. I think founder liquidity and employee liquidity, especially, is like, something that I think has gotten short shrift for a long time. I think employees honestly tend to get screwed a lot at startups. I think, investors might make out and founders might make out, but employees often just like get the short end of the stick. And so I like that we've seen this trend in recent years of, 90-day exercise windows are still the norm, but are becoming, there's more and more companies doing 10-year exercise windows. Because when these exercise windows were originally created, companies would IPO in 3 years, and like people just stuck with this idea of like, well, we don't IPO in 3 years anymore. Like, we should probably change these windows. And I see more and more of that happening. I see, occasionally companies, allowing their early employees to find liquidity through tender offers as they get to Series B, Series C. I think those are the right moves in the right directions for I think equity for employees who are really busting their humps, and tend to end up with a bargain they don't really understand when they sign up. Like, oh, you work your butt off, and then like, oh, I have to pay a bunch of money if I want to leave this company to buy these things that are highly illiquid, and I have no idea if they're going to be worth anything. So I don't know if the trends are going the right way, but I try to encourage, employees to ask. Like, I think employees should get the same information when they have to make a decision that an investor gets. Like to show the data, ask for the data room. Like, why are you asking me to make what's basically an investing decision, right? And when I don't get the same information that an investor would get. And so, I try to push for more fairness and more equity for employees as much as I think about it for founders and LPs. Like, I think that there's a forgotten class of folks in the startup world that are working just as hard as everyone else that kind of end up in a more precarious position than either founders or investors.
Just a few wrap-up questions here. Ethan, do you have any habits or behaviors that are a secret weapon?
I think the behavior I think has been just not listening to what everyone else is doing. And I banished Twitter from when my first daughter was born, and just kind of staying focused on doing the thing that I think makes the most sense has been the most helpful thing for me.
Awesome. And then finally here, Ethan, what's the best way for listeners to connect with you and follow along with Outside VC?
I'm pretty open on LinkedIn. You can reach out to me, or I'm just Ethan at outsideventurecapital.com. And I'm pretty quick to respond to things.
Okay. Ethan, what book, article, or video would you recommend to listeners?
Yeah. I have a book that's from probably 20 years ago that we used to read at my company called Hug Your Customers, that I feel like is probably not on any startup list. And it was really just about getting to understand your customers. And I think that's something that we don't spend enough time on as startups, and getting to understand and know and love your customers. And it really shaped everything that we did as a startup, and it's probably not ever been mentioned on this show, I bet, as a book.
Never heard of it.
Yeah, I'm going to throw out that one.
Love the title, though. Ethan, if we could feature anyone here on the show, who do you think we should interview, and what topic would you like to hear them speak about?
I think one of my investors, Eric Paley from Founder Collective. I think he's always had he's probably been on the show. He's probably has always unique ideas around the world, and just left the world of venture to go into the world of government, and ask him about that journey and why he decided to do that after such a successful run in venture.
That would be a fun one. It's been too long. It's probably been 10 years since we've had him. So would be great to have Eric.
Cool. Thanks for putting up with all the craziness that occurred
all good,
here,
man. So. He is Ethan Austin. The firm is Outside VC. Ethan, thanks so much for the time, and congrats on all the success and early momentum with the firm.
Thanks, Nick.